Should you diversify your portfolio or concentrate your efforts into just a few positions? That's what this video is about, and I'm going to talk about what billionaire Stan Druckenmiller has to say about it. But before I get into that, just want to introduce myself for anyone who is new to the channel. My name is Jack Duffley, and I'm a 24-year-old real estate investor and attorney. And in this channel, I cover a variety of topics as they have to do with investing and personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But a few days ago, I saw a great interview with Stan Druckenmiller over on Toggle AI, which is a smaller YouTube channel, and I guess they run a stock analytics platform of some sort that Stan Druckenmiller apparently likes a lot. But in this interview, they talked about a number of topics ranging from crypto to stock portfolio allocation and many other things. So if you're interested in that, I'll include a link to the full interview below, but I want to highlight one particular portion of it. Now, the question that Druckenmiller is about to answer is, what are the keys to being a great investor? What sets apart those big investors from smaller investors? What makes them great as opposed to the rest of the pack? So here's what he had to say.
So when I've looked at all the investors of very large reputations, Warren Buffett, Carl Icahn, George Soros, they all only have one thing in common, and it's the exact opposite of what they teach in a business school. It's they make large, concentrated bets where they have a lot of conviction. They're not buying 35 or 40 names and diversifying. I don't know whether you remember, Icahn a few years ago put $5 billion into Apple, and I don't think he was worth more than $10 billion when he did that.
Right.
When I went in to tell Soros that I was going to short 100% of the fund in the British pound against the Deutschmark, he looked at me with great disdain because he thought the story was good enough that I should be doing 200%, because it was sort of a once in a generation opportunity.
Right.
So A, they concentrate their holdings. B, concentration, this is very counterintuitive. It really gets your attention. So it actually, in my thinking, decreases your overall risk, because where you tend to be in trouble is if you have 35 or 40 names and you stop paying attention to one. If you have big, massive positions, it has your attention.
So I'm going to pause it right there because there's quite a bit to unpack just in that little segment, in that concentration is something that Druckenmiller sees as a key to being a successful investor. And why is that the case? Well, for one, there is a finite supply of great investment opportunities. That's kind of a given in this situation. Otherwise, this theory wouldn't make any sense. But the hard part is finding those great opportunities, or at least having them comprise a large portion of your portfolio. Because if you're super diversified and you got thousands of stocks across a bunch of index funds or something like that, I mean, there's nothing wrong with that in itself, but this is the counter argument to that, in that when you have a big diversified fund, you're going to inevitably have a lot of losers, and you're not concentrating towards maybe your best effort, your best skill set. Druckenmiller talked about the pound versus Deutschmark trade and how George Soros said he should have put even more money into it when he initially came up with the idea, because it was clearly such a good opportunity compared to the other things you could be investing in. And why wouldn't you put more of your money into that thing if you were very confident that it was good? Now, this isn't to say that just because you have a good feeling about something and you're going off raw emotion, that therefore you should put all your money into that, because that is not what we're going for here. Because he mentions intention and how that's very important too, and that you're being much more careful when you're making concentrated bets. Whereas if you have a super diversified portfolio, you might not be very worried about it. You're not going to pay a ton of attention to it, which, I mean, it has its merits, of course. Passive investing is very attractive since you don't have to put a lot of effort in, but that can come with a significant cost, at least if you have any expertise or knowledge that you could really profit from. And by being concentrated, you have a greater incentive to become an expert in that particular thing that you're concentrating your money into, because that is a large portion of your portfolio. And rather than having to pay attention to thousands of companies and trying to figure out which ones are good, you're instead focusing on your best bets that ideally would have a much higher chance of success because you know what you're doing with those particular bets. But of course, nothing is certain. The only thing that is certain is this isn't financial advice, and what you do might be very different than what a Stan Druckenmiller would do or what some other investor would do, because it's not as though you're only a great investor just because you concentrate your investments. I can concentrate my investment into some pyramid scheme all day, and I'm a concentrated investor at that point, but it's into something very stupid. What I'm trying to say is there's other elements beyond just simple concentration that make it for a great investor, and I think Druckenmiller would say the exact same thing, but let's let him continue.
So the way my favorite quote of all time maybe is, Mark Twain, put all your eggs in one basket and watch the basket carefully.
Right.
I tend to think that's what great investors do. The other thing to me is you got to have to know how and when to take a loss.
Right.
I've been in business since 1976 as a money manager. I've never used a stop loss, not once. Dumbest concept I've ever heard. It goes down 15%, I'm automatically out. But
Right.
I've also never hang on to a security if the reason I bought it has changed. And that's when you need to sell. If I buy X security for A, B, C, and D reasons, and those no longer are valid, whether I have a loss or a gain, that stock doesn't know whether you have a loss or a gain. It is not important. Your ego is not what this is about. What this is about is you're making money. So if I have a thesis and it doesn't bear out, which happens often with me, I'm often wrong. Just get out and move on. Because I said earlier, if you're using a most disciplined approach, you can find something else. There's no reason to hang on to any security where you don't have great conviction in it.
So that's linked very closely to concentration. It's having conviction in what you're actually buying and understanding why you're buying it, the thesis he was talking about. If that changes, then your reason to hold it should probably be gone too if your thesis is no longer there for a reason to hold it. Or at least you need to reevaluate it to make sure that there's not a new reason to hold it or keep your holding or even put more money into it or sell it. Because a lot of things can change with the underlying company, the underlying investment, the underlying assets, the underlying sector. Lots of things could happen that could make something a poor investment, whereas it might have been a great one when he initially made that investment. And to what he was saying earlier, if you have a very diversified portfolio, it's going to be very hard to keep up with tabs on your investment thesis for all 1,000 stocks or 100 stocks or however many investments you might have. And this is not to say that you can't make money that way. There are plenty of ways to make money with investing. This is just one way that Druckenmiller would clearly prefer. And it does make sense, and it is something that you see as a pattern among many large successful investors. They're usually quite concentrated into some sort of investment or some sort of sector, some sort of expertise that they're leveraging, and that is a big part of their portfolio, and they have a thesis for as to why they're invested in it. And if it does change that thesis, they're not going to stay in it any longer because their conviction has dissolved as well. So what can we learn from this? Does this mean you should go invest all of your money into one stock or one piece of real estate or just go all in on one particular thing? Well, maybe. If it really makes sense, given your expertise and your knowledge in something, it could make sense and it could work. Now, there are risks associated with that level of concentration, putting all your eggs into one basket, but there's also risks to diversifying, which I think is the big lesson we can get here. Diversification is not some one-size-fits-all approach to everything. There's value to diversifying, and there are risks with diversifying. The risk typically being that you're cutting away your ability to produce outsized returns, since you're really just getting kind of a little bit of everything, and you're going to follow the markets more likely as opposed to under or overperforming them. And that's totally a reasonable move depending on what situation you're in. I see diversification as a defensive move more so than offensive. Granted, there are plenty of studies that suggest that having at least some level of diversification, even in an otherwise pretty concentrated portfolio, is typically a pretty good idea. It's usually not the best idea to put all of your money into one thing and making an oversized bet on something. But that does not necessarily mean that extreme diversification, where you have thousands of holdings across tons of different sectors and it's just a super diversified portfolio, doesn't mean that that's the best idea either. But again, it very much depends on your competencies and what you're trying to do with investing. Not everyone is built to be some sort of great stock whiz. Not everyone's built to be a great real estate investor. But do realize that at least many great investors tend to have relatively concentrated portfolios, and they concentrate their bets on the things that they have the highest conviction towards. And there are plenty of exceptions to this otherwise vague rule. So just wanted to throw that out there. Thought this was an interesting interview. Again, if you want to see the rest of it, definitely check out the link in the description below. That's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And check out some of the affiliate links in the description below. But until next time, take care.